So let's do a discounted cash flow model on Qualcomm. This is a great way to identify whether you want to buy a stock or not, whether the stock is over or undervalued, looking at the discount cash flow model. This is discounting future cash flows. And we'll just go through the model. So the first step would be I need the shares outstanding. So I'm going to go to Yahoo Finance and I use the market cap and I divide that by the share price. I divide that by the share price. And what's the share price? 75.77. This is a quick way to do it. You can, of course, look at the 10K or something to see how many shares outstanding. So they have roughly 1.1 billion shares outstanding. Market cap for 85 billion. 85 billion, that's a good double check to make sure I didn't mess up. And now we have to enter some other fields to calculate the future cash flow of this company. So we need a free cash flow, and that's in Yahoo also, conveniently enough. They give you the free cash flow. If you go to the cash flow statement, they actually give you the number. You don't have to do any math. It's all there for you. So it's 6.8 billion in 2016. And free cash flow is cash flow from operations minus capital expenditures. 4 billion. And the reason you use free cash flow instead of net income or cash on the balance sheet is because free cash flow excludes non-cash items like depreciation, amortization, any funky accounting things. It's the actual cash that went in and out of the business. So it's cash flow from operations minus capital expenditures. CapEx is like equipment and buildings and things like that. Now let's look at the net income. And as you input numbers, you kind of see things about the company which could help. So let's see, the net income from 2016 is 5.7 billion. The numbers in Yahoo are in thousands, so I have to add 3 zeros. 2017, 2018, they took a loss. And if you want to know why, you can obviously look at their financials, either here or on the 10K, to identify why they took a loss. Sometimes it's not a real loss. It could be an accounting thing. So you have to look into that, because you can see they had positive free cash flow, even though they had a $5 billion loss. Now let's get the revenue. $23 billion in 2016, 2017, 22. 22 again in 2018. And I'm doing this fast, but when you do it, you want to be careful not to put the wrong number in the wrong spot. But I can kind of eyeball it and see it looks pretty consistent, so I'm probably doing things right. And the way we calculate free cash flow is it's kind of a function of revenue and historical revenue and your margins, your net income margins. So I calculate a revenue by taking prior year revenue times the average revenue growth for past 3 years. And then I got my net income by taking that revenue number and taking the average net income margin. Net income margin is net income over revenue. That's how much money the company took home in net income. 24%, which is a pretty good number. Looks like that's the best one. And then free cash flow is simply that net income that I calculated times the average free cash flow over net income. And I'm not going to delve into these numbers too much. It could take forever. But once you kind of work with these models enough, you kind of makes a little more sense each time you do it. So interest expense, because in order to calculate the discounted cash flows, we need to get the weighted average cost of capital. And to do that, we need to see how much debt they have and how much interest they pay on the debt, and see how much equity they have, and to see the cost of that equity. So right now we're just doing debt. So the interest expense is $627 million, and we need the short-term debt, which can be found on the balance sheet under liabilities. Short-term meaning it's due within a year. So the current debt is about $1 billion. And then the long-term debt, which tends to be higher, that's all debt due beyond a year. It could be due in 2 years, 20 years. And you can obviously look at the 10K to figure that out. So the interest on the debt is 3.83%, which looks correct. So I wouldn't question that. Obviously, if I messed up, I put 627 here instead of 627 million. See, I can kind of identify mistakes I made, but everything looks like I'm doing it correctly. Income before tax, that could be found on the income statement. Income before tax, 7.4, and the income tax expense, that's a big income tax expense. Okay. Some reason, okay. Never saw that high before. So it's all over the place. You see the income tax expense is $3 billion. So they're paying 41% in income taxes, which sounds really high. I suspect if you look at the prior years, look how much income tax they paid last year, $5 billion on 500 million. So you can't pay more tax. So obviously there was some type of maybe accounting thing, or maybe they had a prior loss and they're using that loss in 2018. There could be a lot of things and that's why they had a big loss in 2018. You really need to dive into the 10K and try to identify this, and it could take a little time. So obviously I'm not going to do that in this video, but maybe afterwards, if I was interested in buying the stock, I would look into the 10K to kind of figure out why they had such a big loss. But just to play it safe, I'm going to change this to 20%, because it's unlikely they're going to pay that high tax, 40+%. It's probably going to be around 20% effective tax rate. Now the beta, which is the volatility of the stock, 1.38. I would expect to have a fairly low beta. So the WACC comes out to 11.33%, and that's a blend of your debt, the interest paid on the debt, which is 3.83%, and also the cost of your equity. And the way you figure out cost of equity is using CAPM, Capital Asset Pricing Model. And that just uses risk-free rate, beta, and a market return. And that's a formula. And you could find this just Google CAPM if you want to know the formula. So it's 84% of the capital structure is equity. You can see 84% equity because of the 85 billion of market cap, and 16% debt because it has about 16 billion of debt. So that's why the WACC is closer to the CAPM as opposed to closer to the interest on the debt. Because WACC is how much it costs to borrow money. It's kind of like if you had a mortgage of 5% on your home, your WACC, your weighted average cost of capital, is 5%. That's how much it costs you to get that money. But if you had, say, a credit card of 15%, then if you wanted to figure out your combined WACC for these two, you have to figure out the amount of money on each and then do blended numbers. So it may be something like 7%. And that's how we discount future cash flows using the WACC. So we calculate the future cash flows already, and then it's using the 11.33%. You can see right here in the discount factor, because that's year one. 1 plus 11.3% raised to the 1 power, the first power, because that's the first year we're discounting. And then this is 1 plus 11% raised to the second power, because that's the second year. So it gets bigger and bigger, the discounting. And you always do a terminal value at the end. So because you could do it forever, every year you can discount, but generally what you do in these models is you get a terminal value, and that's kind of like after 2023, that's really the value of the cash flows. If you summed up all future years, $21 billion, that's as of 2023, and then if you discount it, it's 13 billion. So you can see the stock price of Qualcomm is $17 according to the discounted cash flow model. So it's a lot lower than the actual stock price. The stock price is 3.5 times as high. So obviously don't buy, but you have to delve into it a little bit more to figure out if this is an appropriate way to look at Qualcomm. Some companies have a negative stock price, like Tesla, because they have negative free cash flow. It's worth a lot of money, Tesla. So you have to figure out the future value and future expectations of the company. Hope you liked the video. Leave a comment.